Hello and welcome to Yahoo Finance's special breaking news coverage of the December Fed decision. I'm Josh Lipton here with my colleague Julie Hyman. Julie, great to see you. So what do we expect? We expect the Fed's going to stand pat, right? They're going to take a breather here because you know what? They cut, but now we can't ignore inflation, Julie. We're running above target. It's proven kind of stubborn. We know we got some fiscal stimulus on the way on top of that. So we got to take a breather here. The question some are asking, okay, if it is a breather, how long is the breather?
I'm not asking any of those questions.
You're not? What are you asking?
No, I'm not asking any of those. How does Jay Powell feel now that he's under criminal investigation? Does he think the Supreme Court is going to rule that Lisa Cook can be removed or cannot be removed? How does he feel about the political overhang at the Fed? And most importantly, is Jay Powell going to stay when his term as chair is
What do you think
done?
he says to some of those
questions.
questions?
I don't know if he answers any of those questions. Can I just say, by the way, the elephant in the room? Twinsies.
Yeah.
I know you guys are all thinking it.
Yeah.
We did not plan this. It just
This is my
this
go-to
way.
Fed outfit. I mean, I expected you to know this already.
I didn't.
Yeah, no, I mean, come on. The people know. Here, to your point, by the way, you think that's where the drama is. You think the question...
Absolutely.
Yeah, a key question about the stance on policy, but you saying it's going to be the criminal investigation of Powell.
Yes.
It's going to be Cook.
Yes.
It's going to be Fed independence. That's what you're getting at.
Yes, it will be. You know, I talked to Christian Hoffman at Thornburg this morning. He said this is a very boring Fed meeting during very interesting times. I thought that was a good way to put it.
Did he give you any color? He thought Jay Powell navigates some of these questions?
I mean...
'Cause I think you're right. That's going to be the drama.
Yeah, he seemed to, most of the folks I've talked to seem to think he will try to avoid saying things about this at all costs. We'll see if he succeeds in doing so, because I'm sure he's going to get the question from multiple different angles and phrased in multiple different ways.
We are just moments away now from that Fed decision. Markets up near flat lines, and we have the decision from Jennifer Schonberger. Jen, give us the headlines.
No change. The Federal Reserve holding rates steady in the range of 3.5 to 3.75%. Now, this was a split decision. Federal Reserve Governors Stephen Miron and Chris Waller both dissenting, preferring to cut rates by 0.25 percentage point. Waller had indicated ahead of the meeting that he still has concerns about the health of the job market. Now, Fed officials upgraded their assessment of the economy to solid from moderate on the back of that strong third quarter GDP reading expectations for a strong fourth quarter as well. They see inflation as, quote, somewhat elevated, and so the job market is showing, quote, some signs of stabilization. Notably, they dropped language from their statement that said that downside risks to employment rose in recent months. The statement simply reading now that the committee is attentive to risks to both sides of its dual mandate. Now, when it comes to the path for future cuts, officials reiterated in their statement that, quote, in considering the extent and timing of additional adjustments, they will be attentive to incoming data, the evolving outlook, and the balance of risks. Back to you.
Jennifer, just want to follow up with you here. Two interesting things in my view. One, that Miron dissented in favor of a 25 basis point cut. He's not arguing for another bigger cut. And that Waller joined that dissent, which is especially interesting given the backdrop that President Trump has still not made his decision of who's going to be his nominee for next chair of the Federal Reserve.
Julie, I am so glad that you brought that up, because I was literally in the lockup looking at who voted in favor for this decision and who voted against. And I thought it was very telling, to your point, that Chris Waller dissented because he is still on the short list for Fed chair. But you know who didn't dissent? Michelle Bowman. And she gave a speech 2 weeks ago that seemed to lay the case for a clear-cut rate cut. And the fact that she did not dissent, it was also telling she's not on that short list anymore. And we know that Governor Steve Miron thinks that they should move faster to where he sees neutral. He sees neutral a lot lower than where rates are right now. The fact that he feels like they could slow down a little bit at this point is also interesting. Maybe that speaks to the strength and the pickup that we've been seeing in the economy. The fact that officials have upgraded their assessment for the economy. They say now economic conditions are solid. They're not moderate. They've also upgraded the outlook for the job market, which is why they cut 3 times last year, right? They took out those insurance cuts. Now they see signs of stabilization.
All right, Jen, thank you. Appreciate it. Now, Julie, you got the decision. Your thoughts on the decision? Give me your top headlines.
Well, the decision is obviously no surprise. The decision itself, as I mentioned, the drama really does center around the composition of the Federal Reserve. And I'm just looking, of course, this is the time we live in. I went straight to Polymarket, of course, and I'm looking at the odds and how much they're changing. Now, when I checked this morning, during my show this morning, Rick Reeder and Kevin Warsh were at the top, and no other potential candidate was above 10%. No surprise, guess who's joined the list above 10% now? Yes, Christopher Waller, who is now at 14%. I think he was at 9% this morning, if that. So, when we see that dissent coming from Waller in favor of a cut, that does seem to be changing, the odds within the market or the perception in the market that he could potentially be the pick. Now,
we turn to the presser.
Yeah.
Now, you know what? I'm seeing Joe Brusuelas, smart economist, friend of the show, friend of both of ours. He says about this presser, agrees with you, Julie. You know what he says?
Tell me.
He says, get the popcorn ready. That's what he says. Joe says, here it is. This will be an FOMC meeting unlike any other, Joe says. And Joe's seen a few of these. We expect that Powell will use his platform, Joe says now, to provide an erudite but accessible defense of central bank independence. The discussion around central bank independence will, here it is, suck all the air out of the room, Jim says, and will most likely, he thinks, see a real-time response out of the White House. We'll see.
Interesting. A real-time Truth Social post, perhaps.
Could
if
be.
nothing else. I think that, that makes sense. That's in line with what a lot of investors are watching here. And by the way, I want to mention that as we're talking about the changing composition of the Fed, that this being the first meeting of the year means there is a different composition of the Federal Reserve Open Market Committee and the people who were voting today. That is Beth Hammack, Anna Paulson, Lori Logan, Neil Kashkari rotating back in for this meeting. Now, the perception is that they are pretty much in line with the folks who are leaving in terms of, them being as hawkish or as dovish as the people who are leaving. But it's just interesting that you get that composition. So when we talk about who's dissenting, who's voting, it's a different group of folks today, to some degree,
for sure,
than it was at the last meeting.
Good point. All right, let's get to Yahoo Finance's Vera Jared Blickery for a check-in on the market action after the Fed's rate decision. Jared, what are you seeing?
Thank you, Josh. We need to get Polymarket odds on the Wi-Fi Interactive. We'll be working on that. But first, let's check out what the Dow is doing. Just barely, it's oscillating between green and red territory. Let's call it that. Basically unchanged. Took a little bit of a dip on the announcement, and then it rose back. But we're talking very, very small moves here. NASDAQ, which had been green, started out nicely green in the morning, just kind of clawing its way back towards some of those highs here, but got interrupted by the Fed announcement, and it's back down to almost unchanged. You can see a small gain there on your screen. Similar story for the S&P 500, except it's been in negative territory since just before noon, and why not the small caps as well? Those have been in red territory most of the day and still down about 13 basis points. But what usually happens is we see the fireworks they kind of begin around the Fed presser, and that's going to begin at 2:30 when Chair Powell takes the lectern there. So we'll see what happens there. And let's check out the VIX, because the VIX is slightly elevated. It was slightly elevated before the meeting, but still with a 16 handle, that's pretty low historically speaking. And then we got to take a look at what's going on with the bond market. 2-year Treasury note futures, those are down slightly. Not really seeing a reaction off of the announcement there. So they were down, and that just means that yields are up because we're looking at the futures and price moves inversely with yields here. And a similar story with the 10-year. We did see yields up before the announcement and maybe up slightly with the futures down slightly, but we're not seeing any big movements however you slice and dice it. I do like to look at gold. Gold took a little bit of a dip there, but you can see it's already up. It hit record highs earlier today, 5,300. It was only last week that it punched above 5,000 for the first time. So that's really your macro indicator right there. And silver futures as well, holding 111, another close to a record high, if not a record high in silver futures. And I do like to check out what's going on with Bitcoin as well. Sometimes it moves, sometimes it doesn't move off the Fed announcement. You can see a little bit of a downside move there at the 2 p.m. mark. The times at the bottom of the screen are UTC, so that would be matching up with 2 p.m. Eastern. You can see Bitcoin holding under 90,000. And let's see what's happening in large cap sectors. Tech has been leading most, if not all of the day, still leading here. It's up 0.7%. Also in the green, we got energy and communication services, utilities just barely holding on to a small gain there. Healthcare, the biggest loser on the day, down over 1%. And then you got staples and consumer discretionary. Again, the consumer stocks have not fared well since late last week, and some of that might be the storm. And then you got a bunch of other factors in there as well. I want to show you what's going on with the NASDAQ 100 as we dive in there. NVIDIA up in the upper left, 1.75%. Tesla up. We got those earnings after bell. That's up less than 1%. The semiconductors looking pretty strong here. We got a few red spots there. Broadcom, ASML, and AMD. But check out Micron in the upper right. That's up 5%. Texas Instruments up 9%. Western Digital up 10%. And Intel up 10%. So some double-digit gains for a lot of several at least, of the chip stocks. And then when you look at software, also seeing a lot of broad gains there. Not quite as extreme, but nevertheless, we got Shopify, we got Snow, Datadog, and Zoom, each up about 2-3% in the case of Zoom. And I will send it back to you on that, Josh.
All right, thank you, Jared. Well, the Federal Reserve makes the widely expected move to hold interest rates steady. For a look into what this means for the volatile bond market, let's get now to Charles Schwab, Chief Fixed Income Strategist Kathy Jones. Kathy, it is great to see you. So we got the decision, Kathy. What do you make of the decision? Is it the right decision in your opinion, Kathy?
Well, I do think it's the right decision to hold off. There really wasn't a lot of logic or evidence that would suggest there's a need to cut rates at this stage of the game. Inflation is still elevated, as they noted in their statement. The economy is running at a pretty hefty pace right now, 3.5% to 4% real GDP. That is certainly strong relative to long-term history and probably relative to our potential. Inflation is still elevated. The financial conditions are very easy, so there's not a lot of evidence that the rates at this level are inhibiting economic growth in any way, and the unemployment rate is low. Hiring is slow, but the unemployment rate is low, so you're not seeing a lot of push-pull in the labor market. So when you add it all up, there's really not much logic for cutting rates at this stage of the game.
Hey, Kathy, it's Julie here. Are we going to get any more cuts under Chair Powell, or do we have to wait for the next person?
I suspect we'll have to wait until after Powell's term is over in May and there's a new Fed chair. And that's what the markets are pricing in. If you look at where the markets are right now, they're pricing in no rate cut until June, and that would be after Powell's term ends. So, one of the things that has to be appreciated is that we're getting fiscal stimulus via the one big beautiful bill that will be kicking in the next several months or so. And that adds a tailwind to the economy that's already running at a pretty strong pace. So again, I don't think the case for rate cuts is going to present itself until mid-year at best, and maybe not at all this year. And that will mean that Powell will have stepped down from the chair position by then.
Kathy, for investors, you talk about risks that you see on your radar, and you emphasize here falling dollar, steepening yield curve. You talk about the big move in Japan's bond market. Rank those for us, Kathy. Like, if I pressed you, would you say one of those concerns you more than the other?
Oh, I'd say the steeper yield curve is probably the risk that I see because of all the things, I've been talking about, that the risk to the economy seems to be the upside, which would tend to push up inflation. And that is probably a bigger risk to investors at this juncture than the other factors. So, the Japanese bond market, it's sort of running in the background there. It's an issue to keep track of because Japan's bond yields have been sort of an anchor in the global economy. So as they lift, it helps pull up yields around the globe because Japanese investors are huge investors offshore. So that would naturally have some impact on the rest of the world. But I don't see that as a huge dynamic for the dollar or for bond yields at this stage of the game. It's more of a gradual thing that's happening over time. So it's more that we get this shift in expectations about what the Fed may do, combined with due to some higher inflation or stronger growth, that will steepen the yield curve and pull those long-term yields up while the short-term stay relatively flat.
Of course, Kathy, who the next Fed chair is and how much pressure the president puts on them maybe will have an effect on what happens with rates. As somebody who is in fixed income, I'm curious who you think the market wants the pick to be. One of your own in the form of Rick Rieder, or is it sort of agnostic on that point?
Well, I imagine if you surveyed the various people on the street, you'd come up with different answers. But I think essentially what most people in the markets want is someone who's going to run a credible policy that balances all the risks. And that's a high order. That's not an easy thing to do. But someone who's got the ability to look at the economy with clear eyes without prejudice, set policy based on what they're hearing from their staff, which is a bunch of economists trying to put together the right numbers, and who will resist pressure to cut rates when there's an inflation risk. Nobody really wants to see someone who repeats the mistake of Arthur Burns in the Nixon era and caves to pressure. So I don't know that there's a single name out there, but I think that someone who can be independent and smart and understands the market would be a good choice.
Kathy, always great to have you on the show. Thank you.
Thank you.
Let's get some more reaction now to the Fed's decision to hold interest rates steady. Joining now, we have Loretta Mester, former president of the Cleveland Federal Reserve and adjunct professor of finance at the University of Pennsylvania Wharton School. Loretta, great to see you. So we got the decision, Loretta. They're holding rates steady. One, what do you make of the decision? And two, Loretta, when do you think cuts could resume?
Well, I think it was the right decision. I agree. There's no rationale for cutting at this point. They had already brought the funds rate down 75 basis points. So that, was their insurance against the softening in the labor market. And as they pointed out in the statement, the unemployment rate has stabilized a bit in the, recently. So that's on the labor side. They're still going to be watching that because there's still, dual-sided risks. They also said that in the statement. The inflation side, they have to watch that too, because inflation has been above 2% for over 5 years. They haven't gotten it back. There's reason to believe firms are telling us that they're planning to pass on some more of the tariffs this year. They've avoided it probably as long as they can, some of the firms, and so they're going to be passing them on. So the inflation numbers, they're still going to have to see how the tariffs play out, and hopefully if their story of how they're seeing the tariffs plays out, they'll get to see goods prices begin to fall again, and then they'll get inflation on that downward path. But there's no reason or compelling reason now to take another move down in the interest rate. In fact, there's reasons to think that there's some tailwinds to growth going into the beginning of the year with the tax cuts. People are going to get bigger refunds, so they're going to feel that they have more money to spend, and businesses will get that depreciation, the full expensing, so they're going to feel that they also can. The one tailwind, though, is the continued uncertainty that is plaguing this economy, and partly because of what's going on geopolitically, our own policies not sort of settling down. And so that's something that I think could it affect the economy going forward. But all signs suggest that the economy is in a good place now to really watch and wait.
So, Loretta, it's Julie here. So what do you think, what are you going to be most closely watching to look for a sign of change, to say either, okay, we feel more comfortable, we can start to cut more, or more worried? I mean, is it more the labor market? Is it inflation? And do you think the Fed's been doing a good enough job at articulating that challenge?
Yeah, I would love to see the FOMC do a better job of really laying out what their rationale is for their policy decisions. And that means talking about what their outlook is, what the risks to that outlook are, but also then using that to sort of explain. And if we see, for example, the labor market deteriorate in a material way, then we're prepared to use our policy tool again. And I think that'll be the catalyst for the next cut. It'll have to be something, I think, in the labor market, or more confidence that the labor market is really stabilized and inflation is on that downward path. But they're already very near or close to neutral, I think. So they don't have that much further to go to neutral. I think if they were to articulate that rationale more fully, I think it actually is a good thing in terms of preserving Fed independence, because then the next chair that comes in will really have to articulate in a similar way what their policy view is. And I think that's a better way of preserving that independence and making sure that the Fed's making policy decisions based on the right data, economic analysis, and not being driven by politics. And I think whoever becomes chair, they're going to have to really show that they're doing policy in a credible way. There's going to be some skepticism around whoever becomes chair. And building credibility means laying out the case. And if the previous chair and FOMC have laid out a case, the new chair is going to have to do more than just say, I read the data differently, and so therefore I want a different policy. They'll have to really articulate a rationale that may perhaps differs from the previous rationale, but they'll have to address it. And I think that's something I'd like to see the Fed doing in the final meetings with Chair Powell, is to really lay out their rationale for how they've been setting policy and why their policy is appropriate.
Loretta, on that point you're making there, Nick Timmeros over at the Journal has a piece out. Here's what he writes. He says, Trump wants something that may not exist. A new chair who will pursue his demands for lower interest rates while still commanding enough credibility on Wall Street and from his colleagues to deliver them. What do you make of that, Loretta?
Well, I think, the president, it's his right to say kind of what his policy views are. I think what's been very unhealthy here is the vitriol and the challenges and the really blatant attacks against the Fed policy, which undermines the public's credibility with the institution. So it's basically trying to tear down the institution rather than really having an adult conversation about my preferred policy path would be this, and the Fed isn't doing it. So already the new chair who comes in is in a very difficult position, because I think Nick is right. That person coming in will need to build their credibility with the markets, but also the general public as well. And every time the president goes out and attacks the Fed, right, it raises questions. Even if the Fed's doing exactly what they're supposed to be doing, which is basing their decisions on the economic situation and really setting policy, only caring about achievement of the dual mandate goals that they've been charged with achieving. The fact that this question has been raised makes it that much harder for the Fed to actually do its job and do it well. So again, we're in a situation now where you can't wind that back. But hopefully the new chair comes in, they will be held to account in terms of having to really articulate a really credible case for whatever policy decisions they want to make, because they're going to have to bring the committee along with them. And I think anybody in that job is going to take the job very seriously. And part of that is knowing that, the U.S. economy really depends on sound Fed policy. And frankly, the world's economy also depends on the Fed setting sound policy. So I guess I would think that any chair coming in would feel that weight, and that would dominate over these external forces that are trying to get policy to move in a particular way. You can have different views. If the new chair comes in, they may have different views than the current chair. But as long as they're really articulating a credible economic case, then I think they'll be able to get the consensus of the committee to go along with that. And then if the case isn't credible, or if the policy turns out not to be the right policy, then the Fed will have to go in a different direction, because they're going to be focused on those dual mandate goals. Maybe that's naive of me to say, but I do think the weight of that job and the importance of it will weigh in a positive direction for whoever comes in as chair.
Loretta, always appreciate that instant analysis. Thank you so much.
Thanks.
Much more coverage of the Federal Reserve's latest rate decision. That is straight ahead. The Fed leaves rates unchanged at the first FOMC meeting of 2026. Here with a closer look now at the Fed's agenda, we welcome in JP Morgan Asset Management Global Market Strategist Jordan Jackson and Nationwide Chief Economist and Senior Vice President Kathy Bostjancic. Welcome to you both. Kathy, as the economist at the table, I'll start with you, of course. So the Fed holds rates steady. We've had two very smart guests, Kathy, already. I asked them, I said, listen, what do you think? They said this was the right call, the right decision. That's what they would have voted for. Right. What do you think?
Oh, yeah, I think absolutely. At this point, that makes sense. And it was well telegraphed by the Federal Reserve, right? Fed Chair Powell did a good job of doing that. Actually, 2 meetings ago, indicated there was a divided committee. But I think what you're seeing is a strong economy, right? Second half of the year, 2025, really robust growth. And the unemployment rate has settled back down lower. As they said, it's kind of stabilized right now. So even though you have sluggish employment growth, which is lagging the overall economy, things still look very good. You know, no need to cut rates now, and inflation's still elevated. You know, we think it's going to trend lower. Most do. If Fed Governor Waller, and I know he dissented in favor of cutting rates. He has made the point, as others, that the true inflation, when you adjust for the tariffs, is closer to the Fed's target. So I see why he dissented, but I think they can, stand pat for a bit, see how the incoming data come in, and adjust when needed.
Okay, so we're a few minutes away from Chair Powell's press conference. They didn't change anything. We know he's going to get a lot of questions that don't have to do directly with Fed policy during this meeting. Stocks are doing bupkis. I'll use Josh's favorite word for when they do nothing. So Jordan, what are you going to be listening for in that meeting that the markets are going to be listening for to give some direction? Or do you think it's all sort of more to do with politics and less to do with the trade today?
I'm quite curious to hear how much Powell emphasizes how close they are to neutral, because that's really the barometer, right? If the economy is stabilizing, if the unemployment rate is economy strong, unemployment rate stabilizing, inflation is meh, if you will, maybe another word to throw in there, then I think they don't need to necessarily overreact. But if he continues to say we're close to neutral, close enough to neutral, then I think this sort of balances 1 cut, 2 cuts. Is 3% really neutral? Because that would suggest, another 2 cuts potentially. And I think Powell's more so around that 1 cut for the balance of the year. So the markets are going to try to read through a lot of today, because today we didn't really get a whole lot. They're going to read through what can we expect for the balance of the year? What could the dots suggest for March? Maybe get a little bit of preview from that perspective.
Kathy, a lot of talk today, and for good reason, about that weaker dollar. I'm curious, as an economist, how you're thinking through that, the risks you see that maybe we import inflation.
It's possible, but the most recent move, while we had a very sharp and one day, if you look broadly, the dollar is still not that weak, and the weakening began well over a year. It was like a year ago, sort of, when we saw that happening, or not quite. Sorry, April was when that happened, Liberation Day. So we didn't really import a lot of inflation. If you look at the numbers, we didn't, and even the tariff impact was more muted than people expected. So I still think there's pretty big disinflationary pressures in the pipeline, service side, and keep in mind productivity growth, 5% second half of the year, that's very disinflationary.
So, okay, so maybe we get that disinflationary impulse, and then that allows for cuts to resume after Powell ends his chairship, perhaps?
I think so, right? The market expects cuts. The Fed is still pricing in some degree of easing over the next few years. So there's still a bias that the next move is going to be a cut. But I do think it is an appropriate policy stance currently to stay patient, see how things play out. We know fiscal stimulus is going to be feeding through to the economy. Many Americans are going to be enjoying a larger refund check than they did last year. We want to see how that necessarily gets spent throughout the economy. I wouldn't write off the fact that we've got the World Cup happening in North America. I believe, United States are hosting 11 of the 16 cities. We're going to see.
Is that inflationary, though? Is the World Cup inflationary because people are going to be spending money?
Well, maybe the U.S. and World Cup could see a little bit of a Taylor Swift Europe effect, right? With a lot of folks coming in, enjoying and spending money, which creates aggregate demand, which could be inflationary. Again, not the full story, but I think something worth acknowledging as we start to move on the first half into the middle of the year.
Kathy, what about those, just to circle back at a quick point, who make the argument, and even at this table, economists saying the labor market is weak. They'll say, listen, the unemployment rate jumped, I think they'll say a full percentage point in 3 years. Consumer confidence numbers we got this week, Kathy, I mean, lowest in, I think it was 12 years, and the data show this renewed concern about difficulty in finding a new job after losing one. The anecdotal evidence we saw, UPS and Amazon. What's your response to that?
Well, I think they're all true, those points.
Hold there, Kathy, because you're coming back, and I'm going to get your answer after. But first, we go to the man of the hour, Fed Chair Jay Powell. That was Federal Reserve Chair Jerome Powell wrapping up his news conference there. Stocks flat here as the central bank holds rates steady as expected. Back with me now for a closer look at Fed Chair Powell's presser. We're back with JP Morgan Asset Management Global Market Strategist Jordan Jackson and Nationwide Chief Economist and Senior Vice President Kathy Bose-Jancic. Kathy, I will start with you. So politics, not surprising, they were front and center, Kathy. Some of the first questions right out of the gate. Powell, though, not taking the bait. He wasn't going there. He was not commenting on the DOJ probe, Kathy. Not commenting if he remains on the board after his term as chair ends. Big picture, though, here's what he said. Clear improvement he talked about in the growth outlook. Said inflation performing about as expected. Some labor market data, he said, suggesting evidence of stabilization. A stronger forecast, he says, overall. What do you make of it? What were your big takeaways?
Yeah, I think that really reflects the data we've seen. Economic growth is quite solid, if not exuberant. We get good momentum coming into this year. Unemployment rate has settled lower, and even though he spent a lot of time talking about slow job demand and job gains, but also that supply of labor has declined, right? So that leaves the unemployment rate still quite low and the labor market balanced. So I think those are really key. What he did talk about a little bit is how there can be a disconnect between the robust GDP growth and the lagging employment.
What'd you make of his answer there?
Well, he said, you kind of tend to bet usually on the labor market data. Mm-hmm. So it could be that what he's saying is that we get to see some downward drift in GDP growth going into this year, which is not really, doesn't square up with all the stimulus that's in the pipeline. That's one thing. But it also could be that it could be that the labor market starts to improve. And I kind of think that's what's happening. I'm seeing some green shoots in the private sector. Now, it's still very concentrated in healthcare. But I think if you start to see that, that makes that completes the picture a lot better, that where you would have solid employment growth and the labor market improving.
How many cuts, Kathy, would you pencil in as of right now for 2026?
So we have two, but we have them in the second half of the year. So we think the Fed, this pause continues into June. By then, just as Chair Powell was saying, we think the tariff impact on goods prices will have peaked. Inflation starts to trend lower, back towards 2%. And we also think we'll have a new Fed chair. Well, we don't think, we know that's penciled in. His term ends in May. So we'll have a new head of the Fed chair position, and I think there will be more dovish, and it'll be helped by inflation trending lower. And while I said the labor market is going to firm, I think it's not going to be strong enough that it'll deter them from cutting interest rates.
Jordan, I want to bring you into your big picture takeaways, Jordan. What did you hear? And by the way, is that the base case for you as well? 2 cuts this year.
I heard that December is probably going to be the last move that we see from the Fed while Jerome's at the helm. I largely agree with Kathy. I think we won't see another round of cuts until the second half of the year after Powell's gone. I'm probably closer to the 1 rate cut camp versus 2. And again, we can argue about the minutia, but I think what was very apparent, and he mentioned this, that there's no base forecast, no governor forecast or voting member forecast that has a hike on the table. And so market expectations, outlook for short-term policy rates is expected to be lower over the balance of the next 12 to 24 months. From an investor perspective, that continues to support this kind of steepener trade that we're seeing. We've seen a bit of flattening actually since the start of the year, but I still think we're in this prolonged period of curve steepening as you've got this Fed bias towards easing the front end.
Kathy, what did you make too of the comments about tariff impact? I thought those were interesting. Powell saying a lot of the tariff pass-through to inflation has now happened, says we do think tariffs are likely to move through and be a one-time impact on inflation from tariffs, he said, likely subsides around the middle of the year. What'd you make of that commentary?
Well, they've learned that the real data, the real-time data have underpinned that viewpoint, right? At first, it was, well, maybe tariffs won't be one-off impact on inflation. That's a possibility, but maybe it feeds into inflation expectations and it becomes more sustained, right? That hasn't happened, right? And yes, maybe you've had a 5 tenths, 7 tenths increase to inflation because of tariffs, but it does look like it's going to fade. And that's really important. And he talked about inflation expectations. They are still relatively anchored. Yes, we've seen some movement, and we have to watch that. If you look at the 5-year forward in the bond market, inflation break-even rates have moved higher, but they're still relatively well behaved. And I think if you look at the long-term picture, in line with a 2% inflation rate.
Jordan, I mentioned how Powell was not going to bite on those political questions. Here's what else he wouldn't bite on. These questions about the decline in the dollar, Jordan, wouldn't go there. He said, hey, listen, we do monetary policy here, right? But you must be getting questions about that. I mean, what is behind that move? What does it mean for investors?
I think you got to think about how it feeds through to broader financial conditions, right? And, I think the dollar has implications for financial conditions. The Fed, I believe, has a shadow mandate of caring about financial conditions. And so, I think this does make its way, but he just doesn't want to be as prescriptive about, how the Fed's going to react to whether the dollar strengthens or whether the dollar declines. Look, we're still very much in the camp that the dollar is likely going to continue to weaken over the 3 to 5 year period. We think the dollar is still overvalued. We think that you look at trade deficits, budget deficit, those twin deficits, the Fed that's still biased towards easing, whereas global central banks are probably more on pause from here. So that rate differential continues to support perhaps a gradually weakening dollar. Again, hard to forecast where currencies go over the very short term, but I do think all these other larger structural factors continue to support a weaker dollar. He was also asked Jordan, I thought it was interesting about the kind of just blistering runs we're seeing in precious metals. He was asked about gold. What do you make of that run? What do you think the signal that's sending investors? I'll be clear. I do think, particularly when you look at gold and silver and the movement that we've seen, it feels a bit overbought in the short term. I'll acknowledge, though, that there are still structural tailwinds to broader precious metals. When you think about the continued strong buying from central banks, which has certainly been happening over the last 3 years, you think about gold continuing to be a strong geopolitical risk hedge. And so obviously with the U.S. coming into the year being on the offensive, geopolitical risks on the rise, that continues to support precious metal prices as well. Then the inflation and real interest rate environment, right? If inflation's still sticky, a concern, Fed's still biased towards kind of cutting rates here, perhaps this relationship sort of broke down between 2022 and 2024, but declining real interest rates continuing to support higher gold prices. And so you've got this kind of trifecta of that sort of supports the precious metal, but the moves that we've seen and the speed at which we've seen these moves does signal to me that perhaps some of these metals are overbought in the short term. While we have you here, Treasury Secretary Scott Bessent speaking to Yahoo Finance about that race for the next Fed chief. Let's take a listen.
In terms of Fed search, we got some great candidates. I was talking to the president about what he's thinking on the plane back from Iowa last night, and my inclination is we may hear something in the next week or so.
All right, Kathy, so the next week or so, there's a potential timeline. What do you make of those comments? How closely are you following this race for the next Fed chief? Your point, Kathy, you were making earlier, we don't know who it'll be, but your point was broadly you would expect, of course, that person to be aligned with the president.
Yeah, oh yeah, absolutely. Yeah. I think we're all waiting to hear who the nominee will be, and we've been waiting a long time, so let's hope it is within a week and it's not drawn out further than that. But I do think, agree, they're all solid choices, or very good choices, actually. And we'll see how that plays out. I mean, I think Kevin Hassard's at first was seen as the lead candidate. He's fallen back a bit, and President Trump has said, I want to keep you in the administration and not to have you go to the Fed. Then you have Kevin Warsh, who would also be a great candidate. Waller, now he dissented today in favor of 25 basis points. So I think he feels convicted. I think the odds rising for Waller, by the way. Oh, okay. Well, that makes sense. And I'm not, certainly that dissenting can't hurt him in this bid. But I think he does feel very strongly that there's concerns on the labor market, and it doesn't take much to have a little more weakening and the unemployment rate really starts to pop, because we don't have a lot of churn. The labor market is not very dynamic right now. And then Rick Rieder is really interesting choice, right? He is a bond market veteran and in a fixed income, and having worked on Wall Street for 20 years, on the sell side, as Jordan. That would be really an interesting choice, and someone who really understands the markets. And I think that is one critique I would say of my years following the Fed, is sometimes it's not always clear they really understand the dynamics of the bond market. And Rick would offer that for sure.
For sure. Jordan, get your thoughts on that as well. I mean, you must be getting questions from JP Morgan clients. What are they asking you about this, and what are you telling them?
I try to say separate the noise from the signal, right? I think, there's a lot of talk about who's going to be the Fed chair. There's a structure in place at the Federal Reserve. Governors spend 14 years, staggered terms. You've got rotating bank presidents. Regardless who's at the helm, you're going to have this constant churn of governors and voting bank presidents that are going to allow for that median member to really continue to shine and conduct monetary policy on a go-forward basis. On balance, some of the voting bank presidents that moved on, Hammack, Logan, I throw Paulson in there as well, probably tilted a little bit more hawkish, if you will, or maybe less dovish is the more appropriate word to use. And so I think that counterbalances a very, very dovish appointee at the Fed chair. And so we still think, policy is going to continue to be relatively independent. But that doesn't mean that the bond market doesn't care when we continue to get political threats and potentially an announcement of a very, very dovish chair.
Jordan, Kathy, great to have both of you here today. Appreciate it. All the help. Thank you.
Thank you, Josh. Happy to be here.
Yahoo Finance's Jennifer Schonberger is back with us for more reaction to Powell's press conference. Jen, your big takeaways.
Hey there, Josh. Fed Chair Jay Powell saying that the Fed is well positioned here, that policy is in a good place, signaling that the Fed is content to hold for right now, in no rush to cut rates. He said there was broad consensus on the committee to hold rates steady today, of course, despite those two dissenters. As for what it will take for the Fed to cut rates, take a listen to what Chair Powell had to say.
We're not trying to articulate a test for when to next cut or whether to cut at the next meeting. What we're saying is we're well positioned as we make decisions meeting by meeting, looking at the incoming data, evolving outlook, and all that. And we're in a position where we still have some tension between employment and inflation, but it's less than it was.
Chair Powell would not comment on the Department of Justice investigation into his testimony on Capitol Hill, nor would he offer any comments on whether he will stay on as a Federal Reserve governor after his term as chair expires in May, though he did offer an explanation as to why he opted to attend the oral arguments for Fed Governor Lisa Cook at the Supreme Court last Wednesday.
I would say that case is perhaps the most important legal case in the Fed's 113-year history. And as I thought about it, I thought might be hard to explain why I didn't attend. In addition, Paul Volcker went to a Supreme Court case famously in, I guess, 1985 or so. So it's precedented, and I thought it was an appropriate thing, and I did it.
As for Fed independence, Chair Powell says he is confident that can be maintained and he is committed to doing so. When asked what advice he may have for whoever succeeds him as Fed chair, he said, "Don't get involved in elected politics. Just don't do it, and curry favor with both sides of the aisle in Congress." Josh?
Wise advice there, Jen. I really like, Jen, actually, your question in the presser, because it's one that's been asked so many times on this show to different economists and strategists. Was you were asking him, Jen, about that interesting divide between the solid growth and the cooling labor market, right? What did you make of his answer there?
Yeah, he says if it's a fight between GDP and the labor market, it's generally the labor market that wins. He says that data is generally more reliable. He says GDP can be difficult to parse. And if that is the case, obviously we've seen much weaker payroll numbers. We know that a lot of structural issues are driving the job market now with lower immigration, but we also know there are some cyclical issues there. So if that is the case, that would be more of a case to cut rates further this year. Of course, we'll need to see if GDP does indeed pop up, if that fosters greater demand for labor. But it sounds like based on what we've seen so far, we're not going to see that anytime soon.
Jen, great stuff as always. Thank you.
Thanks.
Coming up, we're bringing you the top trending tickers on Yahoo Finance. Now time for some of today's trending tickers. We're going to start here with Seagate Technology as it reports an earnings and revenue beat for the second quarter. Analysts highlighting optimism with margin performance. The computer hardware and storage company also providing better than expected guidance for the third quarter. The company pointing to improvement in both the top and bottom lines throughout calendar 2026. Switching gears to Carvana, the car retailer taking a hit following a short report. Gotham City Research claiming the company's 2023 to 2024 earnings are overstated by over $1 billion. The report also alleging that Carvana's earnings are far more dependent on auto loan companies, DriveTime, and Bridgecrest than the market currently takes into account. Gotham's report adding on that it detected accounting irregularities in sales commissions and servicing reported figures. Lastly, Amphenol stock is under pressure here following its fourth quarter results. The electronics and fiber optic company topping revenue and earnings estimates, but providing a lackluster outlook for Wall Street. Evercore ISI noting the beat isn't big enough and that guidance could reflect some amount of sales being pushed from December to March. Company sees first quarter earnings of 91 to 93 cents per share compared to a consensus estimate of 90 cents. Well, President Trump held a summit today to encourage Americans to sign up for Trump accounts. New accounts are part of the One Big Beautiful Bill and promise that the government will deposit $1,000 for every baby born between 2025 and 2028. Several major companies, including JP Morgan Chase, Bank of America, Charles Schwab, Robinhood, Uber, and more, have pledged to match the federal government's $1,000 contribution for their eligible employees. And Yahoo Finance Fed correspondent Jennifer Schonberger caught up with Treasury Secretary Scott Bessent to discuss the Trump accounts.
Look, I think it's taking the capital markets to everyone. I always say it's the biggest merger in history. It's Wall Street and Main Street. When I was a kid in South Carolina, I didn't know about the stock market. I just knew something bad had happened in Wall Street in 1929. And now, for the next 4 years, every child getting $1,000 put in an index fund in their Trump account. They're going to learn about the markets. Their parents going to learn about it. And the president has done peace deals, trade deals, and tax deals, but I think this could be his most enduring legacy because these won't open up for 18 more years. And if someone rolls it into an retirement account, it won't be for 65 more years. But giving everyone a piece of the American dream, I think, is a game changer.
Now, every child who's born for the duration of this administration gets $1,000 to start, and they can contribute up to $5,000 a year, kind of similar to an IRA. Will it automatically be invested in an index fund?
Yeah.
How will that work? And will there be, perhaps at some point, company matching as companies match 401ks?
Oh, no, we have company matching now. So everything will be contributed into the index fund, the lowest cost, broad-based, broadly diversified. But we're going to hear from a lot of great American companies today who are going to contribute. Parents can contribute, family members can contribute. And the other thing that we are seeing is some great American philanthropists are also contributing. So Michael and Susan Dell are contributing to a lot of the children who aren't eligible for the $1,000. So you can open an account per child up until age 18. Michael and Susan Dell have contributed $6.25 billion to all children in America who are not in the top 20% economically of zip codes. Ray Dalio and his wife have adopted the children in the state of Connecticut. We just heard Brad Gerstner has adopted his home state of Indiana, all the children under 5 years. I think we're going to have a big announcement on Oklahoma today. We hope by the day the accounts are rolled out, July 4th, July 5th, that all 50 states will be spoken for.
Could we see even more than $1,000 perhaps at this point?
Oh, it could be much more. I mean, it could be topped up. And the other thing too is, I don't know if I would want to be a toy maker now, because I think friends, parents, grandparents, aunts, uncles will maybe contribute to the accounts instead of give a toy.
You're creating the foundation for wealth for the next generation by giving them a jump start. What about giving children, Americans, the tools they need to manage themselves? For example, we know that American history is mandated to be taught in classes, middle school, high school. What about a federal mandate to teach investing in middle school and high school? Is that something the administration would support? I know you're big on financial literacy.
Yeah, so I've done a lot of work with financial literacy. I don't know if we do a federal mandate. We would encourage states to do it. I think about 2/3 of the states do it now. And I think the great thing about these Trump accounts is that for a lot of families, the 38% of families have no investments in the stock market. This will change that, and I think that it will become the ultimate real-time learning lab, because as the children, the parents look on their phones every day, every week, every month, and they'll become interested. At Treasury, we have Financial Literacy Month, and we're going to keep pushing out more and more. And I think many of this, so the other match that can come is from states. So I think we're going to have 20 states, and I think the states are all going to have financial literacy requirements maybe to receive the donation.
You're also head of the IRS. What are you seeing in terms of account signups at this point for the Trump accounts, and what are your expectations for tax season?
Well, we've already seen 600,000 signups just this week. So the TrumpAccount.gov, if any of your viewers want to go on. And for the IRS, I can see there's going to be a big refund season, because one big beautiful bill was signed on July 4th. And we did not give guidance on withholding changes for the president's signature policies: no tax on tips, no tax on overtime, no tax on Social Security, deductibility of American cars on the loans. So working Americans going to have the very nice tax refunds, encouraging everyone to change their withholding. Now their take-home pay will go up. So I was in Iowa with the president yesterday. We were in a diner/restaurant, and the wait staff there couldn't have been more excited.
I also cover the Federal Reserve, and the Federal Reserve is meeting today. They are expected to hold interest rates steady after cutting 3 times at the tail end of last year. I know that you, the president, have called for the Fed to continue cutting. What is your message to the Fed today, and do you have any update on the search for the next Fed chair and when we could possibly see an announcement?
Yeah, and I haven't necessarily called for cuts. I just said that I think the neutral rate's lower, and I think that inflation is moving down the target faster than maybe some members of the board or the Reserve Bank presidents do. So, but my message is always have an open mind. In my lifetime, we had Paul Volcker, who was a great Fed chair. Then we had Alan Greenspan, and Volcker really had to take a lot of tough medicine, bring inflation down. Greenspan, on the other hand, in the 90s, could see the productivity boom that was coming. He had an open mind, and he let the economy really grow at its potential. Government paid down tremendous amount of debt, thanks to the Clinton administration, the good work of Newt Gingrich and the House Republicans. So what I am saying here is have an open mind that growth does not equal inflation, and let's see what happens. And in terms of Fed search, we got some great candidates. I was talking to the president about what he's thinking on the plane back from Iowa last night, and my inclination is we may hear something in the next week or so.
Mr. Secretary, thank you so much for your insights. So appreciate it.
Good to see you.
Good to see you as well. That's Treasury Secretary Scott Bassett.
Coming up, could Chinese companies having access to NVIDIA's chips give them an advantage in the AI race? We speak to an expert about this next on Market Domination. China reportedly approving purchases of NVIDIA's H200 AI chips, doling out initial approvals to tech giants Alibaba and ByteDance with the expectation that more imports will get the green light in coming weeks. According to the Journal, the move comes as NVIDIA CEO Jensen Huang is visiting China. And joining me now on this, we got Christopher Miller, a professor at Tufts University Fletcher School and author of the book Chip War, The Fight for the World's Most Critical Technology. Chris, it is always good to see you. So we did get news. And you are, in fact, Chip, just the guy to talk about this with. So the Journal reporting, okay, China has approved purchases of NVIDIA's popular H200 AI chips for the first time. Alibaba, ByteDance, they received the initial batch of approvals. You saw that headline, Chris. You saw that report. What do you make of it?
Well, I think it's not a surprise that China wants some volume of these chips. They're more capable than Chinese chips that can be produced at home, and they're available in much larger quantities. So the leading Chinese firms really need these chips to deploy their AI systems at scale. But I think at the same time, China is dead set on trying to become self-sufficient, or at least as close to self-sufficient as it can when it comes to AI chips. And so the Chinese government is going to keep pursuing its efforts to build up its own chip ecosystem to try to wean itself off reliance on foreign and especially American chip suppliers.
What does, Chris, the sort of green lighting here, what does that signal, what does that suggest about the strength of China's, homegrown domestic AI chip companies right now?
Well, I think any objective estimate shows that they're far behind, especially in the quantity of chips that they can actually produce. The best estimates we have are that the U.S. plus partners in Taiwan, Korea are going to produce something like 30 times the number of AI chips as China will this year. So that's a massive gap, especially given China's aspirations to be one of the two largest players in AI. And so China needs these chips. They know it. But they also know that in the long run, they don't want to be reliant on foreign chips, which is why they are so focused on trying to improve their own domestic chip manufacturing ecosystem, even though I think it's going to be some time before they can rival the chip manufacturing capabilities of Taiwan.
Not everybody, Chris, as you know, thinks this is such a smart move, such a smart strategy. Not everybody thinks we should be selling AI chips to China. Anthropic CEO Dario Amodei, you saw this, Chris, recently. Here was his take on this. Says it's a mistake. Says, I think this is crazy, he says. Says it's a bit like selling nuclear weapons to North Korea. What did you make of those comments?
Well, I think it is true that chips will be used for, and already are being used for, defense and intelligence applications. The United States does it, China does it, all of the world's great powers do it. I think the other aspect of the export control debate is, which part of the technology stack do you want to support? Obviously, if you restrict U.S. firms' chip sales to China, it's bad for U.S. chip firms. But if you enable the next generation of Chinese model firms or cloud computing firms, well, that could be a challenge for OpenAI or Microsoft or AWS. And so the balance that we got to strike is to make sure that, yes, you don't want to be too punitive against a chip firm, but you also don't want to be giving the capabilities that will enable DeepSeek or Alibaba or ByteDance to train their next generation of models and provide a tougher competition to U.S. firms.
Let me try to maybe just put the question more directly, Chris. I mean, if the U.S. is going to permit H200 sales to China, what is the risk, Chris, that decision helps in some way China's military AI ambitions?
What we know from the open source is that China's already repeatedly used U.S. origin AI chips for military purposes. There's been great research on this. We know that they're demanding larger volumes of AI chips. But I think it's not just about what specific chip goes to the military. It's about the overall strength of the ecosystem. That's ultimately what drives long-run technological progress. And so by anything we do that helps build up Chinese AI firms, helps build up Chinese AI infrastructure, does give fuel to that ecosystem and makes it a stronger competitor in the long run.
A big question, Chris, it's asked so regularly, is who's sort of leading in this AI race, U.S. or China? How do you answer that, Chris? And how has that evolved? How is it different than if I asked you that, I don't know, 6 months ago or 12 months ago?
I think when you look at the AI models themselves, what you find is that U.S. firms might be in the lead to a small degree, but it's a small lead. China's right behind. If you measure, DeepSeek versus OpenAI or Alibaba's Qwen versus Anthropic, there's not much of a margin there, and the rate of progress is really extraordinary. So on the models themselves, I don't think the U.S. has a very strong lead at all. It's really at the chip level, the ability to put large volumes of chips into the most advanced data centers. That's where the U.S. plus its friends, above all Taiwan, really do have this commanding lead. And that's why there's been so much focus in the U.S. Towards making sure that this lead isn't squandered. And instead we use it to support the next generation of U.S. tech firms.
Finally, Chris, just to bring it back home to the U.S., there is obviously great interest on both sides of the political aisle to really see us ramp up our own domestic chip manufacturing, to become more chip independent. How would you grade the progress we're making there?
There's been a lot of very important investments made by U.S. firms and by foreign firms, Taiwanese, Korean, and others in the United States. But our demand for chips has grown alongside those investments. And so we're making a bit of progress, but there's a long way to go. And right now, when it comes to the most advanced AI chips, they are disproportionately manufactured in Taiwan and Korea.
Chris, as always, great to have you on the show. Thank you.
Thanks for having me.
We're wrapping up today's Market Domination. Don't go anywhere. We're waiting on earnings from Tesla, Microsoft, and Meta, all on the other side of this break.